Well, hi there. So in this video, we're going to be taking a look at Module 22, which is all about kind of a introduction to the financial system. I think it's actually a really useful module to read through because it gives you the very basic ideas of the language that we need here. Like the interest rate is the price calculated as the percentage of the amount owed charged by lenders to borrowers of money. So it's the price of borrowed money, the savings investment identity. Then there's stuff in here that's language that you're probably going to need to know for the test. I would just kind of skim through what some of these are. And if you're familiar with it, great. If not, yeah, you might want to spend a little time. What's an asset? What's a liability? The difference between a physical or a financial asset, things of that nature. So a lot of it is terminology. And I do think if you're not familiar with it, it can be very helpful. So let's kind of go through this module's check your understanding questions. The first part is really just ranking different types of assets based on a few different factors. And the factors they give you are ranked them based on their transaction costs, their risk, and their liquidity. And those are, again, terms that are explained in this a little bit more detail. The idea is transaction costs is like how easy it is for you to literally like transact with that thing. Risk in terms of like, are you going to lose the money? And if you do, are you going to get it back? And third is how quickly and easily can you convert it into cash? That's liquidity. So the ties are, this is kind of just more of like, what do you think? So a bank deposit with a guaranteed interest rate. Well, that's high liquidity, and we'd say relatively low risk, and we'd say low transaction costs. Because it's relatively straightforward to use that for kind of a lot of different transactions. There's relatively low risk that the bank's going to lose your money, and you can very quickly turn it into cash. B is a share of a highly diversified mutual fund, which can be quickly sold. So I would say that that's moderate liquidity. And the only reason I wouldn't defer to high liquidity, even though you can sell it quickly, is that you have to sell it and then you have to wait usually a day or two before that settlement clears and you get your actual money out of it. This is moderate risk, right? Moderate risk, because your money, the value of your money could go up and down quite a bit, depending on what that is. Now, highly diversified means that it's spread out among a lot of different things, so the risk isn't really high. There are mutual funds that invest in much more risky investment tools, so your mileage may vary there. And then I would say, low transaction cost in the sense that it's not going to be a pain in the butt to do the transactions a little bit. So C. Let's take a look at what that one is. I think it's about a family thing. A share of a family business, which can only be sold if you find a buyer and all the other family members agree to the sale. So that is very low liquidity, right? You would have a hard time converting that into cash. Potentially moderate to high risk, because your eggs are all in one basket, because it's one family business, and if that business goes under, your asset's worthless. And I would say actually moderate transaction costs as well, because you have to get everybody to agree, and it's a pain to get everybody on the same page. So kind of these two are often tracking with each other in a way. There's high transaction costs associated with it. 2, what's the relationship between the level of development of a country's financial system and the level of economic development? And think about how the savings and investment spending kind of align to each other. And what we'd expect is that highly developed financial sector could cause a more economic development, right? And the rationale here is because, the more developed financial sector, the financial sector can better transform savings into investments. Savings into investment spending. And remember that that's a pretty important function of the financial sector, is to do that. They're not just moving money around, but they're actually moving money from savers to investment spending, which causes economic development. As we learned in the last unit, we learned that investment spending contributes to long-run economic growth through more productivity. Okay, let's take a look at some multiple choice questions. Decreasing which of the following is a task of the financial system? So the financial system, right, they want to reduce some things. Transaction costs is definitely one of them. They're trying to make it easier for money to be transformed into other things. So that's one. Risk is another one. They're trying to spread out risk and kind of lower risk for individual parties. So that's another one. Liquidity is not really the job of the tax. They don't necessarily want to lower liquidity, although sometimes they do. But that's not really a goal of the financial system. So we would actually kind of more say that liquidity is more like, well, how easy is it to turn an asset into cash? Typically, the financial system serves to actually make that process easier rather than harder. So we would say 1 and 2 only, D. Number 2, take a look at here. Whoops. Which of the following is not a type of financial asset? We know that bonds are a financial asset. There's something of value that's intangible derived from a contract. We know that stocks are. Bank deposits are. We know that loans are. However, houses are not. Houses are not a financial asset. They're a physical asset. So that's the tricky one on this one, E. All right, number 3. The federal government is said to be dissaving. So again, vocabulary term, it's included in the reading, and if you kind of read through it, you'll know what it means. It might be a little harder to do if you just try to piece the puzzle pieces together. But this just means that they're borrowing money, so that means they have a budget deficit. So A. Dissaving is like the opposite of saving, right? A nonprofit institution collects the savings of its members and invests those funds in a wide variety of assets in order to provide its members with income after retirement. This describes not a mutual fund, not a bank, not a savings and loan. That's kind of like a bank. A pension fund is what that one is, D. And again, reading this section gives you actually the 4 basic types of financial institutions, which I didn't really talk about in the lecture video. There are 4 different basic types of these financial institutions, including pension funds and life insurance companies and banks and mutual funds. A financial intermediary that provides liquid financial assets in the form of deposits to lenders and then uses those funds to finance the illiquid investment spending needs of borrowers. Well, that's the bank. That's what a bank does. They take deposits, they turn them into loans, and that's what banks do. So B for bank. Okay, and then FRQ number 2 says list and describe the 4 most important types of financial intermediaries. We're right there. So the first type is a bank, right? And they transform savings to loans for consumption and investment. That's really what they do. The second type is a pension fund. And I'm not really doing these in any particular order. And they transform savings into assets, financial assets typically, but not always. They can own real estate. Transform savings into assets to create stable retirement income. Retirement income. That's what they do for the savers. So the benefit of if you join a pension fund is that you're transforming your current savings into some future retirement income stream. Third would be a mutual fund. And this again, notice the pattern here. They transform savings into a portfolio of assets. And again, this is just owned in shares. So we have a form basically of a similar idea. The mutual fund basically takes your savings, and then depending on what fund you've purchased into, they take that money and they buy other financial assets with it, in theory, to grow your money and to provide you with a steady income stream from the assets that they invest in. So some people use mutual funds to save for their kids' college. Some people use mutual funds to save for their retirement, right? So that in that sense, they're very similar to a pension fund in that way. But oftentimes there's a lot more of a personal level of control over what that money goes into with a mutual fund, and there's less so with a pension fund. With a pension fund, it's everybody's savings going into one pot. And basically at the end of a certain defined age or something, or based on how many contributions you've made, you get money back out of it. Whereas a mutual fund, like your money stays in your own little pot. or at least in theory it does. They're actually taking your money and buying lots of assets with it, but you have like a defined number of shares that are yours that you own of the mutual fund. And the fourth is actually a life insurance company. I know this seems kind of weird, but insurance companies, and we could actually kind of even just leave out that an insurance company basically does the same concept. They transform savings into a contract payout upon the death of the saver. That's essentially what they do. So the way they make money is that you pay them a certain amount of your savings monies, and then they invest it in all kinds of other stuff. And then upon your death, if it's generically an insurance company, if it's like health insurance or anything else, they try to basically invest it in lots of stuff, and that grows the value of the pot of money that they have. And then they pay their bills from that, and they hope that they've got some left over. And so just like with a bank, they transform savings into loans, and they take a little cut of it. A life insurance company does effectively the same thing, as do all of these others. They take a little cut to run the operations. Although pension funds are typically nonprofit, mutual funds, life insurance companies, and banks are typically for-profit. So that kind of affects that. But they basically all do the same thing. They transform savings into something else. All right. Hopefully this helped you. See you next time.